people say, well, my bond funds are safe money. No, they're not safe. They're less risky money. Welcome to How to Retire on Time, a show that answers your retirement questions. Say goodbye to the oversimplified advice that you've heard hundreds of times. This show is all about the nitty-gritty. As always, remember, this is just a show, not financial advice, but you can text your questions to 913-363-1234, and we'll feature them right here. David, what do we got today?
Hey, Mike, when would I use a buffered ETF instead of a bond fund?
Yeah, so let's define what those are, just so we're clear as can be. A buffered ETF is kind of a newer product. I believe it became possible from a regulatory standpoint in 2018. So they haven't been around for a long time. But basically, it is an ETF that operates off of option contracts.
All
so
right.
they don't actually buy the S&P 500 or the Qs or gold or whatever your buffered ETF is on. A buffered ETF is the simple ones are designed that basically they're going to, through a contract, sell away the gains above a certain threshold to then turn around and buy protection for the downside.
Okay.
That's a very complicated thing I just said.
Yeah, there's a lot of moving parts there.
But think of an agreement. Let's say we're in the agreement here, and you put some money in here, and I can say, great, we believe that the market's going to grow by 10 to 12%, but you're not really sure. And you just want 7% of that.
Okay.
So you know that there's 3 to 5 additional percent of growth that could happen over the next 12 months. You're going to sell the contract that if it happens, someone else can exercise their contract and capitalize on the 3 to 5% gains. So they haven't invested in the market, just someone else has taken that upside potential. They've given you money for the right to enjoy those benefits if they were to happen. Not guaranteed, but if they were to happen.
Sounds like quite
Are
a
you with me
gamble
so far?
Yeah.
And then you take the money that you've earned off of selling away those gains, and you go back and you buy protection from another person saying, hey, look, markets go up like 6 out of 7 years. They'll probably keep going up, but just in case they go down, I'm going to buy a contract from you that if they go down, you've got to take the blunt of it. And they'll say, well, that's kind of expensive. And you say, that's okay. I'm okay with that. And then you buy the right to offload or sell basically the downside. Okay. That's how they work. That's how a buffered ETF work. Now let's talk about what a bond fund is.
Okay.
A bond fund is not a bond. This is such a misunderstood concept. So bonds are protected as good as how would you say it? They're protected as good as the creditor or agency or company that backs them.
So what if it's like a school district who needs to...
Yeah, municipal bond.
Yeah, okay.
Great. Is that bond going to pay out? Are the taxpayers going to, own up to it, right? Will it happen or not? Federal government treasuries, will they happen or will they not happen?
Yeah.
So a business, will they be able to make payments and then give you your $1,000 back or not? Like that.
So that's like a corporate bond then.
Yeah, it's all kind of the same thing.
Okay.
The United States government, the Treasury, is considered one of the safer bonds. Municipal bonds may not be fully safe. They could default. Default means they missed a payment. It's not the end of the world. They missed a payment. Okay, it's now riskier, but hopefully you get most of your money back. Maybe you got all your money back by that one payment. Not that bad of a situation. It could be worse. But when you understand the bonds and how they are a contract, in some sense, a debt instrument.
Yeah.
They're trying to raise money, so you give them your money as now you're you're basically like a
lender.
bank, a
I'm
lender.
the lender.
Yeah. That's how bonds work. And the bond market's the biggest market. It's way bigger than the stock market. Most people don't realize that.
Yeah, we never really talk about it, right? I mean, we hear like, oh, the Dow was up, but we never hear about, oh, this.
I know Dave Ramsey hates all debt. I'd be interested to hear his opinion. He's well informed. He's not a stupid man. He's a very smart man.
Right.
I don't always agree with his principles, but he makes really good points about how debt cripples a lot of people.
Mm-hmm.
I'm wondering what his opinion would be on businesses that use debt to grow. Just it'd be interesting because there's some interesting things that businesses will do with debt to kind of manipulate their numbers and their share prices and so on. But anyway, that'd be a fun conversation. Where was I going with that? So bond funds actively trade bonds.
Okay.
A bond fund is not guaranteed by an entity that backs it. So a bond fund can go down in value. So when would you use a buffered ETF versus a bond fund if you don't want any risk of it going down in value?
Then I would use the buffered ETF.
Might be more appropriate.
Yeah. Because the bond fund can go down in value.
Yep. Now, the theory behind bond funds is if the stock market goes down, bond funds should increase in value.
Yeah.
Not always true.
All right.
Okay, so there's two layers to this. One is that, like we experienced in 2022 and 2023, the market was going down and they were jacking up interest rates. That hurt bond funds. But people think the correlation between interest rates and bond fund values, they're correlated. They're not actually correlated. They just rhyme.
Okay. And is that kind of an industry jargon there with things rhyming?
Yeah. So if the Fed lowers rates, people expect bond funds to increase in value.
Okay.
And if the Fed increases rates, people expect bond funds to decrease in value. That's a whole thing unto itself. But the problem is that the Fed controls the cash market, not the bond market. The bond market is typically around the 10 to 20-year treasury and what the market is willing to pay for it. So if the markets go down and there's a flight to safety, more people want to buy bonds. It's not as relevant to the Fed necessarily, but because the Fed may control short-term bonds or short-term instruments, there's an influence there, but it's not directly correlated. There have been times where the Fed lowers interest rates and bond prices still, or the yield still increased. Because they're not actually correlated. They're not tied to the hip. Correlation means you can't separate it.
Okay.
Inversely correlated, they're together. They're not actually together.
Okay.
And so if you assume that a bond fund in a market crash would increase in value, that's a healthy assumption. Because if the market's going down, you might want more bonds in your portfolio. If more people want more bonds in their portfolio, then there's a run to the bond market, so the values would increase.
So typically that's what would happen, but not always.
It's not guaranteed. And that's the issue that I've got here is people say, well, my bond funds are safe money. No, they're not safe. They're less risky money.
Good distinction.
So if you're looking for protection, you'd want to go with a buffered ETF or maybe a CD or a bond itself.
Okay.
Or something that actually has structure, rigidity, and some sort of guarantee or version of a guarantee. If you think that bond funds would increase in value if the markets went down, then maybe a bond fund's more appropriate. But don't assume that they're the same thing. They're very much different.